Good afternoon, good morning, and also good evening from wherever you're watching us from. Thank you so much for tuning in for today's webinar. And for today's webinar, it's going to tackle basically most things about the IFRS update. And then we're going to learn the key updates that every user must be aware of to effectively analyze and interpret IFRS financial statements. And also in this session, Saket, who will be our panelist today and our speaker, will demystify the key requirements and impact of IFRS 16 leases, and also review the impact of COVID-19 on financial statements. And also the webinar is useful for staff in finance and accounting department, auditors, CFOs, executives, and anyone who reviews IFRS financial statements. Today, I'll be your host, William Mwangi, as part of the ABMC, which is called In Full Access Business Management Conferencing International Limited. And I'll just give a brief about what we do. We are an Africa leading training and conference service provider based in Nairobi, Kenya, and with offices in Kampala, Uganda, and Dar es Salaam, Tanzania. We have been in training and conference service provision and operation since 2012, matched up with top-notch experienced management team, spanning a total of 30 plus years of combined experiences in the same field, both at international and regional level. ABMC International is an international affiliated business intelligence company that provides the organization with corporate learning and development solutions required by your organization, both regionally and internationally, by meeting your day-to-day skills need to stay ahead of your competition. So our presenter for today is Saket Modi, and he is the founder and director of Square Mile Global Consulting. That is a London headquartered financial training and consultancy company. He specializes in IFRS, including financial instruments and insurance contracts and Ipsas. Saket has spent considerable time working, advising, and also training in matters relating to IFRS, and facilitated workshops for finance professionals from over 50 countries. Saket has previously worked with Lloyds Bank and Ernst & Young. He is also a chartered accountant in India, holds IFRS certificate, Ipsas diploma, and is a CFA charter holder. So over to you, Saket.
Well, thank you very much, William and Joseph. Good morning, good afternoon, everyone. And first of all, before we start, hope you are all well and safe, I'm sure. Welcome to this webinar. I'm just going to try, make sure I share my screen. Yeah, there is a poll, so make sure you complete which region are you joining us from, which country are you joining us from. And just making sure, can you see my screen?
Yes, I can.
Yeah, okay, thank you.
Good.
Right, so we will go through IFRS and Ipsas updates today. And as William mentioned, feel free to ask questions through the chat and we will try and tackle those questions. Now, when it comes to IFRS, just a quick overview about IFRS. You know, it's been adopted in, say, more than 130 countries, especially for listed companies and their consolidated financial statements. So in the UK European Union, it was made mandatory in 2005, and since then a lot of other countries have moved to IFRS. But the main objective is comparability, transparency, and enabling investors and other users to make informed economic decisions. What we're going to look at is mainly IFRS 16 leases, a big, huge buy the asset, you have an option to pay cash, get the asset, start using it if you are cash rich. Another option is to borrow money from the bank, take a loan from the bank and buy the asset and make payments in installments. Or the third option is to lease, which is a bit like a financing transaction wherein you basically get the right to use the asset and make payments in installments, which would include principal and interest. Now, in terms of lease, we can have large high value items like buildings or airplanes, or sort of relatively small value items like laptops and photocopiers. So IFRS 16 relates to lease accounting when you take on an asset on a lease. So before we move on, there is a poll question. Joseph, have you got that? Or William?
Joseph is currently working on that.
Yeah, so we can see it now. Yeah.
It's on the screen.
Yeah. So if I give you a minute. Right, 10 more seconds. Do make a choice. Okay. Have you all selected? Hopefully you've done that. And William, do we see the selection, the answers now? Yeah.
Yes.
Right. Okay. So adoption of IFRS 16 leases effective from 1 January 2019 is likely to have maximum impact on the date of transition on lessees with operating leases in IAS 17 leases, lessees with finance leases in IAS 17 leases, or lessor accounting. Now we're going to go through this in the next half an hour or so, but this is just a quick question to help you understand where the impact is going to be. And the correct answer is lessees with operating leases in IAS 17 leases. So the first one is the correct answer. And IAS 17 leases is the standard that is being replaced by IFRS 16. Yeah. Right. So what is the big change? As we said, there is an impact which have operating leases under IAS 17. Now, why is this important? We all know that leases in various sectors. For example, we have leases in the aviation sector, retail sector, healthcare has leased equipments, hotel industry, there's immovable property, and telecoms, which also have a lease of infrastructure. Now, what happened with IAS 17 was if you classified a lease as finance lease, it wasn't a problem. Everyone was happy because you could see an asset that was being used in the business on the balance sheet, and there was an obligation, a liability to pay for it. The problem was when you had a lessee. So lessee is the person who hires the asset, and if it was classified an operating lease, then we would only have rental expense in the P&L. So no asset or liability is recognized, even though there was a right of use asset and obligation to pay for it. And the analysts, the users did not like it. They said, look, you're using an asset to generate revenues for the business and you classify it as operating lease. There's no asset, there's no debt on the balance sheet, when in effect, you do have both of that. So there was a conflict with the conceptual framework. So what IFRS 16 does, and that's the fundamental change in the standard, is have a single lessee accounting model. So from the perspective of the lessee, there is no distinction between finance and operating lease. A single lessee accounting model where all leases, there will be a right of use asset on which there will be an amortization expense or depreciation, and there will be a lease liability on which interest will be calculated. So the lease liability is going to be a bit like a loan, that in the initial periods you have high interest charge because the liability is higher, and then as the installments are paid, the principal amount goes down and the interest expense also goes down. So most leases will now be on the balance sheet in the IFRS world, and the exemptions are for short-term and low-value assets. So short-term is where the lease is genuinely less than 12 months. So that excludes leases with, for example, extension options. And low-value assets, well, surprisingly or not surprisingly, not defined in IFRS 16, but generally accepted practice is those which are worth less than 5,000 US dollars or thereabouts when new. So those assets, for example, if you take a photocopier on lease or a laptop on lease, it's a low value asset. You don't have to worry about recognizing an asset and a liability. You just recognize the normal rental expense that you would have done. That's what we were used to in the pre-IFRS 16 days. So there are exemptions, which is just basically to make our life easier. So what's the impact? Just to summarize, previous accounting, which was IAS 17, if it was an operating lease, you only had rental expense on the income statement, no asset or liability, while finance lease, there was an asset on which depreciation was provided and a liability on which there was a finance cost or interest expense. All leases in IFRS 16 will now be as per finance lease. So asset, liability, and there will be depreciation and finance cost instead of operating expense. Obviously, that is subject to the short-term and low-value asset exemptions that we saw just a moment earlier. Now, why this change? It took a long time to put together a leasing standard. But just to give you a perspective, if you took the large IFRS or US GAAP listed companies, and there was a survey done a few years back wherein they took 30,000 listed companies. And what they found was that there was US dollar 3.3 trillion of lease commitments. So that would include both finance and operating leases. We don't have a problem with finance lease. It's all on the balance sheet, but the problem is operating leases. And out of that 3.3 trillion US dollars, we had about 85%, so about 3 trillion US dollars that did not appear on the balance sheet. So even though there was a right to use asset, an obligation to pay rentals, it did not appear on the balance sheet. And this is where people had problems, especially the users. And to put this figure in perspective, 3 trillion US dollars, that is approximately 3 times the GDP of the 2 largest economies in Africa, that is Nigeria and South Africa. Or it is approximately the GDP of all of the UK or India. That's the figure we are talking about. And just to clarify, US GAAP has also come up with their own leasing standard, and they will see all assets and liabilities under lease on the balance sheet. So let's just take a simple example to understand what this means. An entity, lessee, leases a car on the following terms: 3-year lease, and annual payment in arrears is £7,200. And the discount rate is 3.95%. Now, what is the impact of this as a result of IFRS 16 versus IAS 17 operating lease? Now, what you would have done until last year is basically said, look, we're paying 7,200 every year for 3 years, and that 7,200 will be the rental expense. So 7,200 expense every year, no asset, no liability to be recognized. Now that changes in IFRS 16. First of all, when you lease a car, it's not a low value asset because its value is more than $5,000 when new. So you always consider the value it is new. And what you would now have to do is, when you enter into the lease, recognize an asset and a liability. And the way you would do it is you take all the future cash flows. So we've got a 3-year lease, and we are paying 7,200 every year. We've assumed it's at the end of the year. So what we're trying to do is determine the asset or liability on inception. And for that, what we have to do is discount all the future cash flows. So we determine the present value of the liability first, and the present value of the liability is going to be 7,200 that you are paying at the end of each year for the next 3 years, and discount it by the discount rate. Yeah. And when you do that, you get a figure which is 20,000. So on inception, you recognize a right of use asset of 20K and a liability of 20K. And that right of use asset is there with us for 3 years. So we will depreciate the 20K over 3 years, which is normally on a straight line basis. The liability component of 20K, every year we will increase it by the interest, which is 3.95%, and then reduce that by the 7,200 that we are paying. So what will happen is the interest cost or the finance cost is going to be higher in the early years due to higher liability balance, and that is the front-loaded interest expense. So it will not be a straight line impact on the P&L that we saw with operating lease under IAS 17. There will be higher expense due to higher interest charge in the early years and lower expense in the latter years. But over the 3 years, the total expense doesn't change. We're still paying the same amount of cash. Also, what is going to be the impact of this? So EBITDA, you would have heard about the term earnings before interest, tax, depreciation, and amortization. Now, remember, under IAS 17, we only had rental expense. Yeah. So under IAS 17, we only had rent expense. Now we have depreciation or amortization, and we have interest expense or finance cost. EBITDA is earnings before interest. So our EBITDA is actually going to go up as a result of IFRS 16 because that will be before interest. In the IAS 17 world, the EBITDA would have been calculated after the rent expense. And EBITDA, as some of you would know, is a very important figure because it often feeds into valuation of a company. Now, it doesn't mean the valuation of the company is going to change. We still pay out the same amount of cash. But if you are a valuer, if you are an analyst or an investor, you need to be aware about this change. So EBITDA is going to go up for the lessee. Leverage, well, we have more debt now because we are bringing in a liability. So that is going to go up. Cash flows don't change. However, with the cash flows, remember the rent expense would have been a part of operating cash flows. Now, instead of that, our cash outflow is going to be split into two parts. So the first part is the interest, which is maybe still, let's say, operating, or it could be financing also. And the other part is going to be the principal repayment, or the actual principal amount that is repaid, and that will be a part of financing activity. So our operating cash flows are going to go up and financing cash flows are going to go down. So again, it's important if you are analyzing financial statements to understand this impact. And just to give you a real life example, this is the International Airlines Group, which owns a number of airlines, including British Airways. And you can see here that when they move to IFRS 16, they have a column for IFRS 16 adjustments. And you can see here that the fleet went up by 3.7 billion euros, property and equipment by 0.7 billion euros. And there is also long-term borrowings, which is basically your lease liability, which is split between non-current and current, current being the portion that is payable in the next 1 year. So at a high level, this is what the impact is going to be on the balance sheet. On the P&L, you can see here, this is their interim report, the half-yearly report, and you can see that the depreciation charge has increased significantly because we are amortizing, depreciating the right of use asset. There is no aircraft operating lease cost because now we provide for depreciation, and there is also finance cost here. So you will see the impact of those items. When it comes to application of IFRS 16, there are a few challenges which I will just give you an overview about. So one is, if you have a contract, there could be a non-lease component. Yeah. And an example of that would be, let's say you have a building and there is also maintenance that is provided by the landlord. The lease component is the building, maintenance is a service component, and you have an option to exclude that maintenance or service or non-lease component when calculating the lease liability. Or you can choose to club it all together, but what that means is you have a higher lease liability, more debt on the balance sheet. The lease term is not just your non-cancelable period, but if there is going to be an incentive, economic incentive for the lessee to extend the lease, we should take that period into account at inception when the lease is first recognized. So there is some judgment involved when it comes to determining the lease term. Discount rate is the lessor's internal rate of return, but if that is difficult to determine, which is quite likely, then we use the lessee's incremental borrowing rate. And that discount rate is actually lease specific, because the way the standard defines incremental borrowing rate is the rate could borrow against the security as the lease term, and by making the same payments as the lease installments. So against the security of the leased asset. And what that means is, if you take out a lease of a building and let's say lease of a motor vehicle on the same day, you could end up with different discount rates for each of those leases. And lease modifications, perhaps a bit relevant in the current scenario. This is when you actually modify the lease term, or you say you're going to lease more space or slightly less space, or there are any changes to the original terms and conditions. So how do you treat with lease modifications is covered in the standard. So for example, due to COVID-19, some businesses might say, look, we do not need the whole premises that we've been leasing from you. We need to modify it because we won't be able to make payments to you. So is it a lease modification? How should it be treated? What is the impact on the right of use asset and the lease liability? All of those things need to be taken into account. One of the other key changes is the definition of lease. That has changed. And it is now defined as a contract or part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Now, the key change here is the definition focuses on control from the perspective of the lessee rather than risk and rewards. And the asset should be clearly identified. And what that also means in practice is, under the previous standard, you may have had contracts which were identified as leases, but under the new standard, they may not be leases anymore, or vice versa. Previous standard, you had contracts which were not leases, but now they fall within this definition. And what that means is, on the date of transition, you might have to review all your contracts. But what the standard does is gives you a practical expedient on the date of transition. And it says that, for example, if you identified leases or contracts that were leases as per the previous standard, you can assume that they continue to be leases under the new standard also. And contracts that were not identified as leases, you can assume they are not leases under the new standard. It's just literally to make our life easier. Otherwise, you would have to review all the contracts. And the challenge with large organizations, multinational companies, is lease contracts are often decentralized. They are not kept at the head office level. So the head office may not even know about the number of lease contracts that the group actually has. In terms of transition, effective for periods beginning on or after 1st January 2019. So it could be 1st July 2019 if that's when the financial year starts. And there's an option of a full retrospective application where you restate the comparatives, or a modified retrospective approach. It's still a retrospective approach, but you do not adjust the comparative figures. So if you have a financial year from 1st of July 2019 to 30th June 2020, then the adjustment is made in the retained earnings of 1st of July 2019. It's a retrospective adjustment, but the adjustment goes into the financial statements, into the opening retained earnings on the date of transition. So again, it's a slightly simplified approach. If you did the full retrospective approach, you would need to determine the impact of IFRS 16 a year earlier, 1st of July 2018, which a lot of organizations may not be ready with. So this was about lessee accounting, a snapshot of that. Lessor accounting doesn't change. And if you are a lessee which recognized finance leases, you don't have to really worry about it, but do keep an eye out on disclosures. There's more disclosures required to help users understand the impact of leases. Right, great. Before we move on, can you bring up the other poll question, William?
All right, Joseph, are you there? Kindly put up the question. Thank you.
So give you a minute. Right, 10 more seconds. Do make a choice, even if you're not sure. Right, can you bring up the answers? Right, so this is a slightly more advanced question. You are a lessee, non-cancelable operating lease under IAS 17, and now you move to IFRS 16 leases, which means earlier you had recognized only rental expense, no asset or liability was recognized. Now you have to recognize right of use asset, which is amortized or depreciated, and you have a lease liability on which there is going to be interest expense. So the first one, debt to equity ratio will decrease. In fact, it will increase because you have a higher debt on your balance sheet due to the lease liability. The asset turnover ratio is basically your turnover divided by total assets. And total assets are going up because we are recognizing the right of use asset. As a result, the ratio is going to decrease. So it just shows really how many times the assets turned over in the period, and that will decrease. So the correct answer actually is operating profit will increase, because as we saw earlier when we were looking at EBITDA, operating profit you may refer to as EBIT, earnings before interest and tax, and that will go up because instead of rental expense, we're going to have depreciation, which is a part of operating profit, but the finance cost or interest expense will be below the operating profit line. So the operating profit will increase. And I think majority of you got that correct. Okay, so moving on. Other IFRS updates. I'm not going to go into too much detail. There are a few bits and bobs. Just to be aware that there was a new interpretation 23, uncertainty over income tax treatments, effective from 2019. And then there are a few other changes that happened, that are effective from 2019. But these are not new standards. These are changes within the existing standards. Also from 2020, so that is, this year, we do have some changes. Definition of material, definition of a business. IBOR reform is to do with interbank offered rates. And what's going to happen is by end of next year, 2021, we're going to do away with LIBOR, for example, as being the benchmark rate. And every country is going to come up with their own rates. For example, in the UK, it's referred to as SONIA, which is the Sterling Overnight Index Average. So that's going to be a huge impact, especially for banks and also corporates which use financial instruments, because loans, derivatives, a lot of financial products like bonds are priced based on these rates. Conceptual framework, we've got a new one with more chapters added. So that's applicable now this year. And then there's a couple of things, especially the IFRS 17 insurance contracts, new standard on insurance for the first time ever, which is applicable from 2023. But that's a whole different topic. And, if anyone's interested, do get in touch if you are in the insurance industry, because it's quite a complex standard and you must start to look at the implementation now. So what is the impact of COVID-19 on the financial statements? A quick overview. Bill Gates had said in his 2015 TED Talk that if anything kills over 10 million people in the next few decades, it's likely to be a highly infectious virus than war, not missiles, but microbes. Now, hope we had all listened to it. It's not killed 10 million people, but obviously this is a guy who actually knew what could potentially happen. Global lockdown, there's an adverse impact, particularly in certain sectors like travel, transportation, manufacturing, real estate, automobiles, retail, energy, banking. We've had an unprecedented situation last month where the WTI oil future contracts were trading at minus $40. So you actually had to pay somebody to get rid of those futures contracts, as there were no willing buyers. And about half of UK companies, these are the large listed companies in the UK, have scrapped dividends by middle of April. So just shows you how big an impact this COVID-19 has had. And UK and many other countries have announced stimulus packages that have exceeded those offered in the global financial crisis of 2008. So it's just unprecedented what the impact of COVID-19 has been on business, society, and financial statements. But just to tell you, in these times, revenue is vanity, profit is sanity, but cash is king. It's absolutely up time to say that. In terms of impact on financial statements, yes, you'll have impact on the top line revenue, bottom line net income, but what should you be closely looking at? For many private sector entities, it is going to be going concern. Are you going to continue in business in the foreseeable future? So this is going to be one of the key audit matters in certain industries. Receivables, you expect more bad debts, expected credit losses would go up, and IASB has issued some guidance around expected credit losses or impairment of financial assets. Inventory obsolescence, obviously with lockdown, there's a pile up of inventories. Is it past its expiry date? What will you do about it? Are there still buyers? Impairment of assets, including goodwill. And rent concessions, again, there has been an IASB, the International Accounting Standards Board, guidance on how to deal with that, and whether that leads to lease modifications under IFRS 16 or not. And also keep an eye out on abnormal costs, impact of government's emergency assistance, whether it's loans or grants, insurance recoveries, liquidity and the ability to service debt, impact on future dividends and share buybacks if you're an investor, and also management disclosures on commercial impact, future risks and uncertainties. So lots to think about as a result of this unprecedented situation. Right, that was a quick overview of IFRS, particularly IFRS 16. Ipsas is the international public sector accounting standards that apply to government and public sector entities. They are principles based, and they are generally based on IFRS, but with tweaks to cater to the public sector. And I'm going to particularly discuss about two standards which are published and are effective in the near future. So give you a very quick overview of that. But if you do follow Ipsas, bear in mind there are a few exposure drafts and consultation papers, and there are changes coming, which we saw in IFRS in the last few years. So that would include revenue. There's this, there's going to be a publication on non-exchange expenses, which is peculiar to public sector. And then there is going to be public sector financial statements. So that topic is being finalized, and also things around leases. So we will see these changes coming. So do keep an eye out on that. But Ipsas 41, financial instruments, is basically a replacement standard for Ipsas 29 and financial instruments, which was adopted from 2018. And what it covers is classification and measurement of financial assets and financial liabilities, a forward-looking expected credit loss impairment model, which would affect government loans. It would also affect receivables, and then hedge accounting, which perhaps there's less impact. Less people generally follow hedge accounting from my experience. But without going into too much detail, what we have is a classification model for financial assets, which is based on management model test and cash flow characteristics. And based on that, you would classify a financial asset as being at fair value through surplus or deficit, or a fair value through net assets. So fair value movements go directly to equity or net assets, or at amortized cost. And again, there's a distinction between debt and equity instruments. But just to be very clear about this, if you have investments in normal bonds or loans with standard interest rates, and your objective is to collect those cash flows of interest and get back the principal amount, then the measurement continues to be at amortized cost. Yeah? And most banking models, the traditional banking models, or in case of government investment in securities, tend to be that. So most of the portfolio will be at amortized cost, but we will also see that organizations need to go through a process and evaluate that before they conclude it is at amortized cost. And the other bigger change is the expected credit loss model, which is the general approach. And this is where it's more tricky. For receivables, there is a simplified approach, but if you have mortgages, long-term loans, which are huge portfolio, then you have to classify that portfolio into 3 stages. Stage 1 is your performing assets. Stage 2 is underperforming assets, where the credit risk has increased significantly since you originated the loan or made the investment. And stage 3 is the non-performing category, where there has been a credit loss or a bad debt. And depending on the stage, you would provide for losses. So the key change here is you don't wait till your asset falls into stage 3 to provide for losses. That's what's happening right now. you need to provide for losses as the risk of default changes, and small loss in stage 1, but full lifetime expected credit losses in stage 2. So again, in IFRS, the banks took a lot of time to get this right. There is modeling involved, there's credit risk involved, and there is also the financial reporting aspects. So again, just a quick overview on that. The other standard is Ipsas 42 on social benefits for the first time ever. And this basically includes the cash transfers that governments make for state pensions, unemployment benefits, child benefits, income support, and so on. Yeah. So how do you actually account for these? And the general approach here is that you recognize social benefits when the eligibility criteria to receive the next social benefit have been satisfied. So you reach retirement, your due pension. That's when it should be recognized. You become unemployed, the government has to pay unemployment benefits. That's when it is recognized. And then there is criteria on how it should be measured. And that is the best estimate of the costs or the cash transfers that the entity will incur in fulfilling the present obligations represented by the liability. And in most instances, you are only looking at the next payment. And that would mean it is a short-term liability. There is another approach that you can use, which is more like insurance approach, as if these are like insurance contracts, but that becomes more complicated and you have to refer to IFRS 17 for that. But again, both Ipsas 41 financial instruments and Ipsas 42 social benefits are applicable in from 2022. So do make sure that if these standards impact you, that you are prepared for that. Right, so that's it from my end. Questions?
Wow, thank you so much, Saket, for that excellent presentation. So we'd go straight to the questions and answers, and I would like the participants to kindly share with us if they have any questions. And also, if you would want to ask a question directly to Saket, we can be able to unmute your microphone. Do we have anyone? Kindly, if in case of any question, kindly raise your hand. I'll give you 30 seconds for us to give the questions.
I give you insights now that you have Saket. Perhaps, William, as we continue, perhaps have Saket conclude.
All right.
Yeah, and then we can proceed with the next agenda as we wait for questions.
All right, no problem. Kindly, Saket, do you have any closing remarks on the IFRS?
Yeah, so again, as William and Joseph said, if you have any questions, feel free to ask, or if you think about one after we have finished, again, feel free to email ABMC and I will be happy to tackle that for you. Just see, have we got anything? Yeah, so all I would say is that both IFRS and Ipsas, especially IFRS in the last decade, has been a bit like a moving goalpost. We have standards, but those standards are being replaced or changed. And Ipsas is going to be a moving goalpost in this decade with new standards on revenue, expense recognition, especially non-exchange components, and leases, social benefits, public sector, financial instruments, and so on. So again, something you should prepare for. Never underestimate the time that would these things take to actually implement it in practice. And as you know, Joseph mentioned, any questions you have about any of those things, or including the courses that we offer, which I think Joseph's going to mention in a bit, just feel free to get in touch with ABMC.
All right, thank you so much, Saket, for that. And to clarify, all this information will be sent, all the presentation slides, so don't worry about where you're going to get them. We're going to share with you right after, probably within the course of today or tomorrow, so that we can be able to go through whatever Saket has been able to take us through. So, and also would like to take you through, just a moment. Oh, excellent. Excellent. Thank you so much, Joseph. So we wanted to inform you of our upcoming virtual Ipsas updates masterclass, which is going to happen between the 8th to the 12th of June 2020. And that's going to be at 2 days, 4 hours a day masterclass. And it is $90 per delegate. And Saket Mod is going to be the facilitator for the class. So kindly, we're going to share with you also the link for the registration. Kindly take note of the dates, 18th to 12th of June, and also we're going to register you for the class.
Someone has raised an arm. Perhaps you can take a question from them.
Okay. Yes, we have a question from Eric. And he says, I think it's better to clarify those theories. Is it theories or theories? IFRS and Ipsas from the source. Some of us do not remember about it, and better to start at the beginning level. Example, which source of IFRS or Ipsas?
Yeah, I think it's a very good question, and often we come across this. You know, both IFRS and Ipsas, huge numbers of standards, and not often that we will use all of them all the time. I mean, again, it's a 1-hour webinar, so there is as much we can do. But when we have our courses, we do go into the details of, you know, where we are coming from, if you need to know more, there are, you know, there is the IFRS Foundation, which have their website, and there's the Ipsas board, which have their website, and also a lot of information around their functioning and where, you know, the standards come from and the thinking behind that.
All right, thank you so much. Eric, I hope that answers your question. Thank you so much, Saket, for that. And I also would like to remind the participants that we have also some of the programs that we currently have. Okay. And for you to be able to check out some of also more of our virtual online classes, we can go through our email, our website, which is www.intl-abmc.com. That is www.intl-abmc.com. From there, you can be able to see some of the courses we offer, especially when it comes to Ipsas and also the certified financial accounting. So perhaps, Saket, you have anything to add?
No, just, you know, get in touch, and we do have this IFRS and Ipsas updates in the week of 8th to 12th June, you know, 4 hours for each one, and we will go through some of the changes in more detail in case you need to apply for the year end or half year end. And then we also have a couple of programs that we're introducing. One is on World-Class Manager, which is to develop managerial skills. It's an online accredited program which helps you become better managers. And there is, you know, a lot of support available through monthly webinars, and also through worksheets that you would do as you go along. So that's a certified program, accredited program. And then we've also got programs which are accredited on, again, on blockchain, cybersecurity, and data analytics. And these are accredited by the Association of International Professional Accountants, which is basically the American Institute of Certified Public Accountants, and CIMA, you may have heard of. So we do provide programs for audit, accounting, professionals on that also. So do get in touch with ABMC if you are interested. These are online courses. You can do it in your own time, at your own pace, and at the end of it, you get accredited accreditation and a certificate.
All right, thank you. Before we end the webinar, kindly, Eric has also asked, I do not see well the impact of this outbreak on the FS. Is there any accounting entries which will be changed?
So I think the impact on of this outbreak is huge in terms of, you know, that we have a lockdown and businesses or entities are not doing any business. So the question is, in terms of accounting, yes, if your inventory is obsolete, you will have to have an accounting entry to impair it. If your assets are not going to realize what you expected they would in terms of revenue generation, then there is going to be an impairment. If your customers can't pay the amounts that are due to you, you will have to impair those receivables. And you know, you might decide to, heard in some instances, close down certain facilities. A lot of people say, look, working from home is working and we don't need these expensive leased offices. We maybe need half of that space and we can always get some people to work from home, in which case your lease contracts will be amended, and that might have an impact on financial statements. So there is definitely impact that you would need to consider, and if any of the values change, valuation changes, that will translate to accounting entry.
Right, thank you so much for that. Also, I'd like to thank all the participants that have taken their time to come and be able to listen to Saket Modi for the presentations of the Ipsas and the IFRS updates. Thank you so much. All the details about what Saket has been able to present, I'll still say that will be shared to you. And also kindly, I'll also still insist that kindly don't forget to register for the upcoming virtual Ipsas updates masterclass from the 8th to the 12th of June. 2 days, 4 hours a day, that is $90 per delegate. So Joseph, do you have anything to add?
I think there is one more question about the certification.
Okay.
So just to be clear, our certification, so there are different programs, and I think Joseph can add to that. The IFRS and Ipsas accreditation, Joseph can tell you a bit more about it. The World Class Manager is a CPD UK accredited certification, and the blockchain, cybersecurity, and data analytics comes from the association in the US, which is the biggest accountancy body in the world. And that is comparable to ACCA or CFI, I think you meant, or CFA you meant. But that is the accountancy body. And also the IFRS and Ipsas updates. Is that correct, Joseph? It comes with a certification? Yeah.
Yes, they both come with certification also from the American body, the Global Academy of Finance Management. So they are also equally accredited qualification programs. So they get top-notch accreditation as well.
All right, thank you so much, Joseph, for that. Saket, do you have anything to add?
No, thank you very much, all of you,
for
attending. If we can help in any way, let us know, and stay safe and be positive.
All right, thank you so much, Saket. Kindly
Saket.
don't forget to also to like our Facebook page, that is ABMC International. Follow us on Twitter and also on LinkedIn. And also don't forget to also check out Saket Modi on LinkedIn. I'm sure he is there. You can be able to connect and also ask any questions. And also, would like just to thank you for you taking your time also to be with us through this webinar. And also thank you and God bless you.
Thank you, William. Thank you, Saket. That was amazing.
Thank you.
Thank you very much, everyone. Thank you.
Thank you, the participants.
All right.
Bye-bye.